Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Today, I'm going to talk about optimism, how we measure it, whether it's overly excessive, and what lies ahead. It's Friday, January 24th at 2 p.m. in London. A central tenet of investing, including credit investing, is to be on the lookout for excessive optimism. By definition, the highest prices in a market cycle will happen when people are the most convinced that only great things lie ahead. The lowest prices, when you love to buy, happen when investors have given up all hope. But identifying peak optimism in real time is tricky. It's tricky because there's no generally agreed definition. And it's tricky because sometimes things just are good. Investors have been excited about the U.S. technology sector for more than a decade now, and yet this sector has managed to deliver extraordinary profit growth over this time, and extraordinarily good returns. Yet this debate does feel relevant. The U.S. equity market has soared over 50% in the last 2 years. Equity valuations are historically high, both outright and relative to bonds. Credit risk premiums are near 20-year lows. Speculative investor activity is increasing. And so have we finally hit peak optimism, a level from which we can go no further? Our answer, for better or worse, is no. While we think investor optimism is elevated, corporate optimism is not. And corporations are really important in this debate, enjoying enormous financial resources that can invest in the economy or other companies. While we do think corporate confidence will pick up, it is going to take some time. One of our favorite measures of corporate confidence is merger and acquisition activity. Buying another company is one of the riskiest things that management can do, making a great proxy for underlying corporate confidence. Volumes of this type of activity rose about 25% last year, but they're still well below historical averages. And it would be really unusual for a major market cycle to end without this sort of activity being above trend. Another metric is the riskiness of new borrowing. Taking on new debt is another measure of corporate confidence, as you generally do something like this when you feel good about the future and your ability to pay that debt off. But for the last 3 years, the volume of low-rated debt in the U.S. market has actually been shrinking, while the issuance of the riskiest grades of corporate borrowing is also down significantly from the 2017 to 2022 average. Again, these are not the type of trends you'd expect with excessive corporate optimism. Uncertainties around tariffs or the policies from the new U.S. administration could still hold corporate confidence back. But the low starting point for corporate confidence, combined with what we expect to be a deregulatory push, mean we think it's more likely that corporate activity and aggressiveness have room to rise, and that this continues throughout 2025. Such an increase usually does present greater risks down the line. But for now, we think it's too early to position for these more negative consequences of increasing corporate aggression. Thanks for listening. If you enjoyed the show, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.